Doubling your money every 5 years. This is the paradigm shift. And we can't promise that we can do that, but I can tell you that if you have a track record of doing that, it's powerful. And so I think one of the reasons why we're getting momentum all over the world right now and building portfolios and helping people succeed is because this isn't our first rodeo. We've done this a number of times. 4,000 homes, nearing $1 billion. It's all captured. How many of you know what this is? You use this regularly. This document, Krohn Consortium, we give it away for free online. It's in a link below for those of you watching this for the first time. This talks about our system. So I just want to spend a little bit of time really enunciating exactly how we get to those ROIs.
'Cause we're gonna be legends. What we're doing here ain't just scary. It's about to be legendary.
Check this out, I've got this on the big screen. We're gonna talk about 4,000 plus homes. We're buying homes nearly every day, 15-year track record. This says $500 million aggregate value. We're coming up on actually $1 billion. And this is in 65 distinct locations. Because by the way, do we buy real estate everywhere? No. Do we buy it just anywhere? Do we buy it in people's backyards? The market is made up of 324 markets. And the likelihood of you having a good market in your backyard, I'll tell you this, if you go to the very best markets, you will naturally, organically double your ROI just by being in the right place, which introduces the first problem. How does Joe, Martha, Bobby, that live in Oklahoma, access the very best real estate that's out of state? Without a team, that's freaking terrifying. So we built a team, 200 experts. So if this is representing our track record just from 2013 to 2016. And you'll see here that these 3 years alone, they represent $258 million spread over these markets right here. Our average purchase price, $143,000. So by the way, let's talk about real estate real quick. Who knows that there's a lot of risk in real estate, that you can lose money in real estate? Here's how most people do it. They have strategies that are market dependent. So by the way, when the market goes up, who's happy? Everyone that owns real estate is happy. When the market is going down, who's unhappy? Most people owning real estate. When the market takes a really big hit, as it does every 12, 15, 18 years, the K-wave cycle, Kondratiev cycle, 3,000-year cycle, we've been tracking this for a long time. And the reason why cycles adjust is because it comes to population, supply, and demand. I'm going to show you a graph in a minute to show you, but I'll tell you this. When the market goes down, in a really bad way, like in 2008, we had the Great Recession. 2008, $1 million home becomes a what? Becomes a $500,000 home. And a $500,000 home becomes a $300,000 home. 300 can become 220, 220 can become 180, 180 can become 170, 170 can become 160. But at some point, you get into a threshold where your greatest insulation is in entry-level single-family homes. Now, I know everyone here has read my book, The Strait Path to Real Estate Wealth. That's for free online. Anyone can have it. It documents why unless you have $2 million or more money, the easiest way to make your first $2 million, I believe, single-family homes bought below the median, these price ranges in the best markets with ROIs greater than 20%, like we've been talking about. Does this make sense? Yeah. And by the way, is this get rich quick? It's not get rich quick. It's something that takes time to do. When you start looking at the markets and you start aggregating all the numbers, you begin to see patterns and basically make decisions from all of the accumulated data. They call these actuaries, where we literally go into zip codes. We can measure which markets are the very best, which we're going to talk about. But next, it's all about operating inside a really tiny box where everything is same and homogenous. Does this make sense? Kris, one of your homes that you sold, you were there in 2008 afterwards, went into Phoenix. You bought some homes in that market, right?
Yeah, my first property was a home outside of Phoenix in the suburbs, picked up for just under $80K.
By the way, that was a home. Do you remember at the peak of the market before it dropped what it had been worth?
About $240.
So a home that had been worth $240,000, Miller picked up for what price?
$80.
So by the way, when the market is in the dump, is it the best or worst time to be in real estate? It's the best. But everyone else will tell you what? Because everyone's values have just what? And so when your value drops, everyone says things are bad, confidence is low, but actually it's the best time to be in the game of real estate. By the way, when the market is going red hot and you know what you're doing, can it be the best of times? Mm-hmm. Guys, if you know what you're doing, it's always a good time to invest in real estate. What happened to that home that you bought for 80?
2.5 years later, it was worth 160, and me and my wife gave each other a high five, sold it, pivoted to a new market.
So you doubled your money in 2.5 years. Awesome. Dude, guys, give it for a Milner. That's freaking awesome. So you can always crush it in real estate. So on the last 2,000 homes, what's our average total annual ROI? 25%. Has that number gone up? Currently that number is probably sitting closer to 26, 27%. Average cash on cash, just shy of 8%. Average purchase price, 143. So we've turned this into a boring science where we haven't learned anything new in real estate for years. We've got the system, now what we do is we run the play over and over again. Our process for buying homes, we use 17 different methodologies for finding properties. We will go to auctions, we'll go straight to the MLS, flyers, short sales. There's a number of different ways, but basically the first thing we do is top down, we analyze and identify the very best market because I don't want to do real estate in my backyard. I would never buy real estate in this backyard right now as a way to multiply investment properties. We establish our teams. Right now we have about 200 professionals connected to each other through the whole process to do everything from finding the right product and identifying the properties. We have a massive research team performing the extensive property analysis, underwriting it, and then acquiring groups of properties. This is essentially what a REIT would be doing, a real estate investment trust, except we do it for individual partners. This just shows you some of the markets that we've been in and that we're going in right now, guys. Florida's our what? It's our number one growth market. We're doing consistently over 25% annual ROIs in that market. Indianapolis, Memphis, in the right areas, those are where we're probably averaging around 25, 26% average ROI, but we have a higher cash on cash. And there's a lower TOP, total out of pocket, in those markets. There's some of those homes where you can get into a home with 20% down on everything at 25 grand. Florida could be 40, 45, or $50,000, so there's a range. But overall, the bottom line is that our ROI is at over 20%.
Yes.
So when we talk about actually doubling money, the biggest secret to doubling money is having a stable asset that you can get your hands on that is producing what kind of ROI? 20% plus. And by the way, when we're doing 25 or 30%, this is where we start having some cool phenomenons where people are doubling their money faster. When the market is in the pooper, that's when our ROIs can be the highest. When the market is coming up here, we're super conservative in the markets, the price points. So people know this. This is the secret. If every 5 years, like let's just say for a moment that someone could access a 401k, an IRA, other people's hidden assets, and let's say that they found a way to buy 3 homes in their first year and then did nothing, but had them growing at 20%. 5 years later, if we sold those 3 homes, then we might be able to trade them out for how many? 6 homes. And theoretically, 10 years later, if we sold those 6, we might be able to trade them for what? Okay, this is the level of multiplication that allows people in time to become financially free. And if they want to be faster, then all they have to do is just along the way continue accumulating assets, not just saying, well, there was a time 10 years ago where I renegotiated my assets and bought 3, and that's all I ever did. This will build you amazing wealth. But what happens if you're paying yourself first, partnering and bringing other resources together? So people want to know, how did I become financially free at 26? I did not have the means of buying 25 homes. I had the means to buy 3 homes. The other 22 homes were bought with what? It started with a partner that then became, and you guys know how that went down, right? Like after I had bought my first partner, that's when I realized that what I could really do was get more partners brought on. And as I brought more partners into the system, you know what happened? I got to the point where I was buying a house every month. In the beginning, we're just trying to figure out how do we help someone get their hands on 1, 2, or 3 homes. But I figured out how to get a home every month. And then it kept growing and accumulating. Can you imagine what happens with time? Your exponential curve becomes insane. But ironically, at the early game, all you need to do is focus on what? One house that is doing this kind of ROI so you can double your money. Does this make sense? I talked about this a little bit. On the next page, I'm going to give you a little bit more. But when we have run out of houses, then everyone wants more houses because population, babies, migration demands it. People are upgrading their lifestyle, we get more houses, but somewhere along the way, we're so above the rebuild value that people are now building houses, spec builds, which means they're speculating that if I build this house, someone should get it, right? But if you get to the point where everyone is spec building houses and then all of a sudden people can't buy a house, what's the problem? A home is only worth what
someone's willing to pay.
Someone is willing to pay. So by the way, when you have an excess of inventory, guess what happens to construction? It stops. And it will take how many years before population will catch up and then use up that inventory? It takes years. It can be 2 years, it can be 3 or 4 years, it can be 5 years. But after 5, 6, 7 years, we have a problem. If we go 5 or 7 years without building, what happens? All of a sudden, there's all this demand pent up, and the banks have to restructure and say, all right, we need houses again, and lending becomes easier, and they loosen their grip. And so we go from peak to trough to peak to trough, all the while real estate is always increasing. So if you take a look at this, there's a recovery period, and an expansion period, and then a hyper supply where we have too much, and then all of a sudden, Nick, we go into a recession period. And it's a circle. And by the way, this circle will never stop. It'll stop when we stop making babies. By the way, has that happened in parts of the world?
Yes.
Europe, Japan, there are places that are actually facing a problem where they have too much real estate and population will never catch up. Fortunately, we're talking about America, and all people all over the world are still investing in. That crisis phenomenon is called economic winter. There are parts of the United States that are forecasted to hit economic winter 40 or 50 years from now, but it's not right now. The average investor going into real estate, can they produce 20% ROIs? No, in fact, many of my partners actually come to us with portfolios and they are not hitting these kind of ROIs. The numbers are actually really dismal here. What we do that allows us to get this high of a number is we have a top-down approach to economics and we have a bottom-up. Top-down eventually says, we evaluate over all the different markets in the United States. We look at the population growth, affordability, employment growth, wage, supply and demand, business growth, wholesale formation, and migration. Those factors intersect to tell us the hottest market to be in. So we don't look at a house. We shop for a market. No one does that. That's why they're not winning as big as they can in real estate. You don't shop for a house. You shop for a market. Once you've identified the best markets, and by the way, I'll always identify the best markets for either cash flow or growth. Once you have that, then we look in at the homes and say, renovation costs, lease up timing, rental rates, rent growth, operating margins, turnover rates, occupancy rates. Those are the most important factors that tell us this. So half of this ROI is, are you in the right market? And the other half is, are you buying real estate the best way possible? Does this make sense? Who's connecting with me on this, right? So by the way, this entire team of 200 experts, who can access it? Do we want to partner with everyone and anyone?
No.
No. Have we had some partners in the past that we've learned from?
Yes.
Like, have you ever dealt with difficult people on the phone?
Yes.
So I want to ask this. Who can partner with me? Who can partner with this team? Only the right people. By the way, who are the right people? People who are open-minded, teachable, and coachable. People who actually look at the track record and say, I'm making a decision based on a historical track record. People that realize that the accumulation mindset is going to freaking be their financial death. It is the weirdest thing. Listen to Dave Ramsey. Listen to the financial prudes out there. And they're telling everyone, save, 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 pay everything off, accumulate, accumulate, accumulate. And they're like, that's a great plan when someone doesn't have a plan. It really is. But if your plan is, at retirement, I would like to even just live off of my current standard of living, that plan sucks. Like, it's a plan for failure. And by the way, poor people go to heaven every day. If you can get to heaven and be unhappy, you don't need money for happiness. But money does equal opportunity. So if you later in life want to have equivalent opportunities to the lifestyle that you've created, or opportunities that exceed what you had during your working years, you have to actually make a break with that. Now, by the way, have we had bad partners in the past?
Yes.
What makes a bad partner?
Demanding.
Because, by the way, a partner comes into this arrangement and says, Kris, you do 100% of the work, nearly, and we're going to be 50-50 partners, right? They're putting up the money, and we're putting up the all. We're putting up everything, the teams, the research, the boots on the ground, the going in, the making it happen. And people are like, well, am I getting 50-50, this 20%? Guys, this is not the goal. The goal is here. The goal is to get your money to a triple-digit ROI, which means you've got to allow it to build. And being a 50-50 on that, that's a racehorse. Like, that's incredible. But there are some people we don't want to partner with who have made bad partners in the past that we've learned from. People who panic. If you partner with me, they have to come to our what?
Events.
Every quarter we put on a 4-day event. They have to come out and be here live and in person, because the event is probably 1/4, 1/3 financial training, like technical training, but what's the other 2/3? It's psychology. Because by the way, winning in the game of real estate is all up here. And if you allow an unrented property or a long turnover or wanting to sell but it's not timing in the market right, if you try to go against some of like reality, dude, that can totally mess you over. And it messes most people over. By the way, the first 5 years, you're going to make less money in real estate likely than you've ever made before compared to the next 5 and the 5 after, and how it actually builds and accumulates with time. So good partners and bad partners. This team is available for people to actually partner with, but we have a limited number of homes, we have limited supply, and we want to work with the right people that get this, appreciate this, will come to the training. And dude, those are the people that we're going to freaking crush it with. Those are the people we're going to win with. Like we've got on our team, we got Paul Olson. I think he's bought like 9 houses now, and he's been partners for just barely a year. Like he's crushing it. Paul's a stud. He's got a great mindset. He works well with the team. He communicates really well, and we're having an incredible experience. And you know, we got so many partners that we could cite that we're having that experience with. But yeah, those are some of the things that we're looking for. You've got to figure out, how many of you understand now that we can double the money every 5 years? Like, it's so important to be able to communicate this. This is a document that we send our partners or those considering being partners. This is a property in Florida. Now I want you to take a look here. To acquire this property right now, the total investment is $44,000. That is buying it at $159,000, the down payment, the closing costs, rehab, acquisition is $44,000 to get in that house. But its cash on cash is what? 7.17%, lower than the average because this is our growth market with higher appreciation, but just also paying down the principal. Literally, we're actually making money in time that we're going to collect on paying down the interest. That puts us our ROI at 11.63%. What's the total ROI cash on cash plus appreciation? 32%. By the way, is this a winner?
Yes.
Is this exciting?
Yes.
Do I love buying properties in Florida?
Yes.
100%. In this training with you right now, I am not going to go into the rest of the numbers here, but there are complicated formulas for everything that we do to answer every question. We have conservative assumptions, but there's a couple of weird screwy things I want to point out. We're looking at, it says that the annual appreciation is 8% in the next 2 years. Actually, year over year for the last 3 years, that market has shown 11%. Why are we showing 8% on the pro forma?
It's a perception thing. If you promise someone 8% and they get 11, they're overjoyed. If you promise them 11 and they see 10.5, they hit your guess.
So it's managing expectations. Here's another one. By the way, we're assuming that appreciation by year 6 goes down to 3%. That's stupid for the hottest, fastest growing market in the country when you learn the economics of why, but it is to be conservative. The other thing here is you're going to see a property management fee. What's typical property management going to cost?
10%.
10%. What is that number? In that market, in that specific area with that property management team, it's 6%. How do you get that? Guys, the way that we win is volume. If you buy an out-of-state property and you're a nobody and you're paying a property manager 10% and there's $1,000 in rent, that relationship pays them how much a month? How much loyalty can you buy for $100 a month? Guys, they're playing a numbers game. They're Walmart. Whether you're happy or unhappy, here's the sad truth. They don't give a rip because you're $100. I know it sounds crass, but they're managing hundreds of homes and they're winning as a collective. And if they have some people that are unhappy, they'll swap you out for new clients. But when you go to a property manager and you say, hey, we're going to give you 500 homes in the next year or two, and you're one of the property managers we're going to go with, this 6% is a concession they make where they want your business, they're fighting for your business, and when you call them, if you're having a bad experience on a property, is it just one property?
No.
The entire portfolio is at risk. That's leverage. You win with leverage, you win with bulk, 100% of the time. All right, so this is Memphis, Indianapolis. This house looks super different. It's not newer like the one in Florida. This is a $92,000 purchase price, not $159,000. So to get this property, the total investment is $27,000, not $44,000. It's a big difference. When people have limited hidden assets and 401ks and stuff, is this important?
Yes.
But this market is different. In this market, look at our cash on cash. The other one was just over 7%. What's this one? 9.3%. That means that every month there's more cash in hand on this property. Does that make sense?
Sure.
However, why is the total ROI with appreciation at 26%? Because this market, when you take a look at our annual appreciation rates, this is not a growth market. This is not a fast-paced growing market. We're going here for collecting a slightly lower overall ROI, but more of it that you get to keep cash in hand along the way. Does that make sense? Now, people are always asking me, Kris, should I do Florida or should I do one of the cash flow markets? And do you know what my answer is? This is important for our fulfillment team working with our clients when they want to know, well, why wouldn't I do this or why wouldn't I want to do a Florida? If someone says, I have in all of my assets to work with from hidden assets that we're going to talk about next, if they say I have $120,000, we know that we're going to say, okay, if I were to get you a property in Florida and let's say it's 45 grand, but I also want to have $10,000 in the bank to manage it. That's called our what? Swan account stands for sleep well at night. Is this important?
Yes.
This is to keep them from being insane worry warts that we want to dump on the curb and say, we out. We don't want to work with you. This helps people feel good when they're new to the game of real estate investing. And then they're like, oh, well, I could do another one of these, but if I did one of those other markets, I could do a $30,000 and we're going to add another $5,000 to their sleep well at night. And they're going to start saying, should I do more of these or should I do more of those? Do you know all I care about is being over what? Don't get confused. This looks like real estate. This is a product, and it's all about producing an ROI over what?
20%.
And if this one's 26% and the other one's 32%, are we over 20? My personal rule is I actually like to be over 25. If I'm over 25, I feel like we are freaking winning the Kentucky Derby every day of the week. So I don't get caught up on this. Well, I was researching the market, and I noticed that FedEx instituted a new policy, and they're going to be hiring this year. I'm like, right here. The question is, how accurate are we in hindsight to what we're projecting on our ROIs? We're dang good at this, guys. This is really what I care about. So at the end of the day, the market actually doesn't matter very much. Making sure that as much of your money as possible goes to work earning these ROIs, that's what trumps it. That's what's really key here and what's really important. So we all understand that this is what gets someone to the point where they say, I want to partner with this team. I want to access the 200 experts. I want to go into the very best markets. I want to make this happen. Does this make sense?
Yeah, sure.
Where we're going to head next is we're actually going to go and dive into those two markets. In this document that people get, what you're looking at here are addresses of homes that we have purchased for ourselves, for our partners, for our clients, and turn the page. And turn the page. And the numbers are changing. And turn the page. And turn the page. And guys, this goes on forever and ever and ever. This will actually show you a couple thousand of the homes that we have done. So people go into Google, they research it, and at the end of the day, here's what people need to know. We know our stuff. This is like our system. This is actually how we run it. And by the way, we did it in 2008. When the next market drops, we're going to do it again. And bottom line is real estate. We're making a sector. It's probably one of the best sectors of investment that people can access, that they just don't know how. They don't know how to do it in bulk. They don't know that teams are out there. I don't know of another team out there like ours that actually does what we do, which is why this is all about bringing investment grade opportunity to the individual user, to our partners.